Again looking for my parents, but I don't know their last name.
It's Dirt. Isn't that the name on the family crest? Dirt.
No, see, my last name's Dirt. My dad made my last name Dirt for some reason. Anyway, I just put an E on it, pronounce it Dirte. It's no big deal. It actually sounds pretty cool.
Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, June 17th, 2022. S&P 500 currently sitting at 3688. I'm David Zarling. I'm here with the conductor of semis, Ian McMillan. Always plenty to talk about, and we always feel like we should give people the information they need regarding the market. Where would you like to start?
Well, another not so great week for stocks, for sure. I mean, bearing a amazing close today in the next 2 hours. An okay week for bonds. Maybe, still below. We did have a pretty big breakdown there today. Not a total flush yet, or not today, but this week. Not a total flush there yet, but TLT below 112, 113.
Yeah, TLT representing 20 plus year treasuries.
Yeah.
Kind of a big breakdown. At the same time, like you said, if it reclaims 113.50, is that a false breakdown at a time when people are because it was a big noise event this week, right? The raising of rates.
We had the Fed, and the initial move was higher. That day, right? It was pretty well known what they were going to announce, right? We know that it was leaked. 75 basis point hike for rates, and immediately the next day, Thursday and Friday, stocks have moved lower.
Yeah, and wouldn't that be classic if that was some type of false breakout in rates? Yeah. We'll see. Time will tell. I'm a firm believer that the Fed tends to react to the credit markets.
For sure. Yeah.
The other way around.
Long-term rates running into 30-year treasury yields, running into some resistance to that 3.45 area. That's where we peaked in November 2018. And it's a big behavioral level going back a few years.
Yeah, we could see rates pause here.
Absolutely. Longer term rates higher. Let's get above that 3.5. Let's get above 2018.
But you look at the weekly data. Ian, if I can point you to TYX, which represents the 30-year treasury yield, and you look at what happened on a weekly basis, this 3.45 level on 30-year, and here we have what's called a shooting star. So they gapped it higher, and now they're reversing it. And a huge noise week with like you said, the leaking of the 75 basis point hike. And now, could you see rates reversing here? We've seen false breakouts in plenty of other things.
I'm sure you're going to hear a lot of this. Is it priced in? I don't know how people can tell if something is priced in, but what is it, buy the rumor, sell the news type thing? Maybe we'll see. I'll let you know in a couple of weeks how it turned out.
Well, and if things deteriorate even further in risk on assets such as stocks and crypto, if they worsen, are asset managers pivoting towards the least worst? So your treasuries, they're still not great, but they're the least worst. And so are you buying those things? Could you see treasuries return to a place where it just doesn't move down as bad? You could, but a false breakout in rates would match. We've seen false breakouts in plenty of other things for the past, 6 months, almost 18 months. We've been in a bear market for 18 months, contrary to popular.
You've got junk bonds. So we know that junk bonds, fixed income has been absolutely obliterated. And you've got junk bonds making new relative highs against stocks.
Right.
So, think about that. That's how much people market participants don't want to own stocks right now, is that they still rather own junk bonds, which, go pull up the chart of junk bonds. Those haven't seen buyers for months.
Junk bonds are down 7.5% in 3 weeks. Since 2021, they're down almost 17%. I mean, and we continue to see credit spreads moving higher. So it's not like, what we're not saying here is that bonds are great.
No.
It's just that
And you got another, I mean, you look at preferred, you look across the fixed income complex, and it is, I mean, we're right back to where a lot of these areas were in March 2020.
Yeah, for sure. And you have some highly liquid areas like commercial paper that are still
And you've
not.
got, I mean, junk bonds this week back to where they were March 16th. Right. And so now a lot of people are going to say, well, March 16th, we bottomed a week later. And I'm not sure that that's the mindset to be taking here.
Yeah, exactly. And with false breakouts, we've seen that in the equity space. This isn't new. Whether you're looking at a large stock like Merck, Pfizer, even a
right. And these are
like
defensive names. Pharmaceuticals, I believe, are seen as defensive names.
I mean, Merck is a false breakout going back quite a ways, going all the way back to the year 2000. So we're talking about 22-year false breakout in something like Merck. You look at something like Pfizer, and it's on the verge of doing the exact same thing going back to 1999. You look at something like Newmont, right? So we're thinking gold miners, places that are supposed to be safe haven. That's another one.
Especially in an inflationary environment.
Right. And that's a false breakout going back to 1987.
On a monthly, the monthly chart is unfortunate.
And we're seeing this across a lot of things. I think of a name like, more recently, Cisco, right? Cisco Systems false breakout back in December of 21 has led us lower. There's more and more examples of this.
How about Moo and MOO, ticker MOO, and Nanner, NANR, both had, I mean, these were, right, we talk about February, March of this year. They were continuing to go higher, kind of with that industrial metals theme and commodities and aluminum and tin and nickel and all that fun stuff. And so Moo, one of the strongest areas that has held up, especially in 2021, also breaking. I mean, it's finally, we've got a lot of areas that are just now entering their stage 4 declines.
Can you explain that? What do you mean by stage 4?
So stage 4 decline is, trend analysis concept from Stan Weinstein about trends. Trend 1 or stage 1 is a base. Stage 2 is the uptrend that merges out of that base. So an uptrend, a bull market. Stage 3 is a sideways market, like we saw out of a topping, like we saw out of small caps and lots of these big ranges that started last February or March. And so that's your range 3. And then when you break lower into your downtrend, stage 4, we've got a lot of areas that are just now exiting stage 3, such as Moo or natural resources, NANR, the big nasty weekly candles this week.
Well, and for those listening, we'll post an example of these stages on Twitter using Stan Weinstein's methodology. But no, important information regarding some of these things. Like, you can even look at some of these things on a sector. Like you mentioned agriculture, you mentioned, was it rare earth or no, natural resources? NAR.
XME had a nice bounce a few weeks ago. It has since failed. It's back below that 48, you want to call it, 48 level. Not a great look.
And then to combine with that, is it fair to say we're in stage 4 for healthcare, semiconductors, and materials?
Yeah. Healthcare and materials, 2 sectors that had tried to hang in there and are finally just, again, I mean, I don't know if you want to call it, if it's a ton of selling pressure. I think a lot of this is lack of buying, which is just as dangerous.
Yeah, it's also supply demand dynamics.
Yeah,
right?
Supply demand doesn't always have to be like people are rushing to the exits. It can just be that no one wants to enter the building.
No, exactly. And here we have healthcare breaking below an important level. That it's the second largest component of the S&P 500, below 125, using something like XLV. Semiconductors being an important growth or risk on area of the market.
Yeah.
Breaking something using SMH breaking below 217. Materials.
SMH, how about transports? I mean, those are your two big areas, right? Semis and transports breaking the new. I mean, these weekly candles are, and maybe we rip 2, 3, 4% in the next couple of hours to end the week. But as of right now, rough.
Yeah, it is rough. And materials is the poster child for an inflationary environment. And even that, they came from that this week, right? XLB, a good proxy or ETF to use for monitoring what's going on with materials below the very important 79. The reason why I say important is I just don't want to throw out words, is that's where buyers had showed up in July of 2021. Again, in September of 2021, October of 2021, you could argue in
May.
February, March of this year.
Yeah.
May of this year, and they failed. So meaning supply could not handle, there was not enough demand to outpace supply at this level. And now
had a couple of attempts to break out last year. I mean, even I could argue 3 attempts that tried to move above 88, 89 and was thwarted on all of them.
And so here we have a scenario where second largest sector in the S&P healthcare breaking an important level, the poster child for inflationary stocks, materials, not high risk, but risk on sector like semiconductors breaking an important level. And then you look at the commodity space, which had been an important barometer for both relative strength, because we were seeing plenty of relative strength out of commodities, even though it was narrowing. And here today, or over the last week, we've seen them come for the last pieces, which were natural gas and crude oil. And
they came for energy. So we have our question answered that we asked last week on the podcast.
Right.
Will this become a sell everything environment?
No, it's
looking to be like people just want out.
Yep. They want out. And I would even argue it's not like gold looks amazing in this environment, but one ratio that we've been looking at and poking a stick at for months is the copper gold ratio.
Oof.
And that's finally breaking down.
Yeah, so that's your industrial metals versus your precious metals. And copper on an absolute basis gonna hit new weekly closing lows.
Yeah. Dr. Copper.
Back to, March 21, believe it or not. I know you do believe it, because that should surprise no one. I mean, how many times on this podcast have we talked about February and March 2021? And like you said, it's not like gold looks amazing, but you've got copper breaking down on a relative basis. Look at that weekly chart. That's a pretty in your face move there. Yeah, there's not a lot of second guessing going on what that weekly candle looks like. And
no, this is literally video footage of the murderer with the murder weapon. The evidence is slam dunk now towards risk off behavior. I'm always open to the fact that exactly the minute after I say that the low is marked.
Mm-hmm.
But in order for that to be true, for the thesis of upside to come, like a sustainable upside, I'm not talking about a bear market bounce. I'm talking about sustainable upside. Is this relationship in copper gold? You'd like to see that reclaimed, and mathematically, you'd want to see healthcare reclaim 125. You'd want to see semiconductors and materials reclaim their important levels. You'd love to see S&P 500 reclaim important levels. Even starting at something like 4,100. And
it's hard. Yeah, it's hard to find much out there. I spent some time this morning going through our ETF database. And so one thing I would say, one way we could describe what has held up best in this current drawdown is things that didn't make new lows below their May.
Mm-hmm.
Their May monthly lows. So like May 12th-ish was kind of a big bottom for a lot of areas. And it has been some of these names you mentioned, like biotech, pharmaceuticals, which we've talked about. I know we've talked about them breaking down, but they are on that list where we talked about Merck and Pfizer, things like that. How about rare earth though, Dave?
Yeah. That's
obviously China. We know China's done well.
I like what you're doing here because you're saying if we just mark the bottom with this podcast, what are the areas that are holding up is basically what you're saying,
yeah.
which would be the areas of future leadership.
Let's say we come in Monday and S&P futures are up 3, like where we start work Monday, Tuesday, Wednesday, we start working through some levels. What are some areas that have held up that could be risk on? Solar.
Well, and you mentioned rare earth metals, lithium.
Yeah, rare earth. Silver miners now, I would say precious metals have kind of had a mixed bag during this recent downtrend. I mean, and silver's not doing great today, but is not below its main lows, which is the main point of this conversation. Gold is on there too. Corn, emerging markets, Asia, which, I mean, China has been kind of a tailwind for a few of these areas.
Right.
Video games are on there. Cloud computing, a lot of the ARK funds, to be honest, a lot of the ARK funds have not made new lows yet. I'm saying that can happen, but again, for the sake of this conversation, they are on the list. So some areas to be thinking about should things turn around in the next few sessions.
Yeah, there's some relative strength out there, and it's worth paying attention to. But overall, I mean, we're in an environment, and I hope we can paint this bigger picture using some of the things we're going to say next. But for example, the Russell has now given up, Russell 2000 has given up all post-COVID gains. So you think about February 2020, the market panic crash, the recovery, and then moving higher largely. So like move.
November 2020.
Yeah. And we've given it all back. So you could have held cash from February 2020 till now,
in the same spot,
and be in the
minus
same
inflationary
spot.
Pressures. But
right.
Yeah, that is. And I mean, I remember, I know you do too, that November, right? The gap, you had the gap above the pre-COVID highs back in November, like 9th, day before my birthday. I know that was the market god's gift to me, and a great rally. And I mean, you think about that Q4 rally and how strong that was. And then we've spent basically a year rolling over and giving all that back.
Yep. And it's interesting, right? Happening in an environment with such dollar strength, because, you know, the textbooks would tell you, oh, dollar strength, that should help domestic small cap companies. Not so much right now. And the dollar is strong, you know, going out to 20-year highs.
It is strong. Well, and that's, we talk about so many of these, how many of these big macro relationships should we turn into, and Dan Russo had a good comment on this morning. Okay, let's say we go into a true rates are going up for multiple years. How many macro relationships and things we've become dependent on are going to get tossed out the window of these? Dollar lower, this asset does X, dollar higher, this asset does Y, and all all the ripple effects that rates have on theses out there. A lot of textbook theses based, that have been built over the last 45 years when rates have been going lower. How much of that gets tossed out the window? I think it's going to be fascinating to watch that unfold like you've seen this year. Why do crude and the dollar keep marching higher together? I don't know. But does that become the new normal? Maybe.
It could.
I'll let you know in a decade.
I was going to say, how about in 35 to 40 years, which is the cycle of rates?
Yeah.
In 35 years, they could be talking about all these things in the inverse and how that's how they operated. And that's why markets are a beautiful thing, because you can't just marry relationships. You have to take each chart on their own merit and not get so caught up in these different factors and try to build models that are built on these factors that only have 30 to 40 years of history. Markets have been around way longer than 30 to 40 years. And there's so many dynamics in play. And that's why technical analysis and the study of supply and demand is so important, because price shows us when to not own bonds, when to not own stocks. Anybody can hit the buy button. It's about hitting that sell button. And that's a huge deal. And so, to your point, regime shift, absolutely. I mean, we've seen stocks and bonds sell off since the beginning of the year. That's not new information, because the technicals have shown us that. Does that continue for the next 30 years? Only price knows. No idea. Now, what I think is fascinating is when we look at the market as a whole. So it's a market of stocks. So it's not just the S&P 500. It's not just the NASDAQ. There's individual stocks and what they're doing. And we've got some data from VandaTrack that talks about that the average retail portfolio is now down 34%. Whew. That's an estimate, but it makes sense when you think about the breadth underneath. When you think about what's actually going on.
You've been involved in small cap growth, which has been the hot area for years.
Which is larger than the COVID panic. The amount of the percentage loss. Yes. And so only 2% of stocks.
COVID retail, I mean, you almost didn't have time enough to react. If you're it sucked for a couple, 3 or 4 weeks, but then you ripped higher just as equally.
Well, in the COVID panic, you had.
And buy the dip worked in the COVID panic too, didn't it? It was reinforced.
It was reinforced, and you had bonds move higher during the panic. And
yeah,
that's different. That's
true.
Now.
A lot of that was offset.
It's different now. We have a larger, if we just did it in nominal terms, in dollar terms, $15 trillion worth of, and I believe this was from Bespoke, a drawdown of wealth because of stocks and bonds moving down together. This is one of the bigger evaporations of wealth we've seen.
And then you've got inflation making it a double whammy.
Versus 9 trillion in 2008. And it's because of stocks and bonds moving together. And then that's not even including crypto.
Yeah.
Because
that's new lows. We're below 21,000 on Bitcoin now. I believe last time, I looked earlier today, we're around 21,000.
20,000.
Ethereum's close to breaking back down into triple digits. It's not, and right, that's a big risk on. We wrote about this to clients this week on Tuesday, I believe.
Mm-hmm.
Of just these, there just continues to be building evidence that, and again, if you're a client, you obviously got this email, but there just continues to be building evidence that no one is really interested in moving into risk on assets, whether it's small cap growth, Bitcoin, junk bonds, just no demand there.
No, exactly. And it's crypto, and it's right. It's just this generic term, right? And it's kind of like internet stocks in the 2000s. You could say that, and it meant just like so many things.
Yeah, you're right. It's a great example.
And so it's tough because Ian and I are believers in there is something there in blockchain technology. There is something there in tokenization. There is something there in NFT transactions. There's something there. But the amount of supply that's hit that area, you don't need to be a hodler. Like, there's no reason, like, why evaporate? And for many, it's probably already happened. Unfortunately, if you're not using important price levels to identify where you should be not involved in something anymore. We talked about 30,000, 29,000 on Bitcoin. How many times on here?
Oof,
and that's not I told you.
Even higher.
Right. And that's not a I told you so moment. It's just understanding that the crypto asset area of the market was definitely a risk on, risk off barometer. We continue to see lows being taken, or previous highs taken out, previous areas of support taken out.
But the 30,000 was the big, that's a multi-year support there. We consolidated there for a month underneath. Couple attempts to break back above, both were slapped down. So what ensued? And there's not a lot. I hate to be the bearer of bad news, but there's not a lot of support in the way. And it's fun on the way up. It's fun when things go way up, straight up, parabolic. On the way down, from a technical perspective, that doesn't leave you with a lot of support areas.
Well, both Bitcoin and Ethereum they're down 70 to 80%.
Yeah.
From the highs. That 70% is a big deal.
Bitcoin's down 69%.
That's
over 70 actually.
Yeah, you're in an area where you have to get 233% to get back to even.
And that's life-changing money to life. That's a huge trade unless you're just back to get break even for you.
Right. Like I said, this is not to throw shade. It's not to hate, because there's something here, but we talked about the $30,000.
It's to bring light that people don't want to own this type of stuff right now. And it's an asset. It's an asset that can be owned or bought or sold, and people are selling it.
And
that's what it is.
And the regulation is about to come in.
Yeah.
Because there's going to be so many people hurt that'll finally,
they're going to whine about it.
That they're going to wake into the fact that, like, having rules for the game you're playing makes sense. There's a reason why white stripes are on a football field.
That's a good point.
I mean, it helps us play the game. And if I don't know where the white stripes are, if I don't know where the out of bounds is, I don't know if I want to. The game might be fun. I mean, we played this game back in the day where if you got the football, you got tackled. You know, it was just
what'd you call it, Dave?
Nope, not going there. But it was a game without boundaries, and it was fun.
Yeah, it's
fun. But you also got lit up.
Yeah,
and you knew the risks. And I think for some, they didn't necessarily understand the risks of crypto, and here we are. And so I hope
it was one of those things where buy the dip worked for years.
Yeah. Yep. For example, but I will say, you know, the stake and yield game where you're getting 7 to 20%, you know, yield farming and staking in an environment, in like massive, like multi-trillion-dollar areas that are in the 3%, now 5%, and you're sitting here telling me, I don't know. My mama told me there's no such thing as a free lunch.
How many sports arenas do you think are going to have to be renamed in the next 24 months? Because
yeah.
And
it's, again, it is not a slam dunk moment. It's a dunk on people. I'm just saying there's real pain, real people, real wealth evaporation, and technical analysis is a risk management tool that can be used in any space that is liquid and can be tracked on a chart.
Well, and it's a shame that we had a lot of people who are seen as bastions of knowledge in this area telling you to buy it. And, you know, I'm not going to call it any names here, but there was a lot of thought leaders in the area that were telling you that crypto was, this was the way to.
You were supposed to mortgage your house and you're supposed to mortgage your business and buy these
things.
This
is how you upgrade your lifestyle. This is going to lead you to the promised land. You, the blue collar worker, like this is going to get you over the top. And just so many of these things ended up being scam. I mean, you think about like the Super Bowl commercials with Matt Damon, and like it's just so cringy.
Right. Fortune favors the brave. And
yeah, it's
yeah, I know. And I'll reiterate, out of the ashes, if there's ashes, like, I call it down 70%, 80% ashes, because that's a lot.
It's a lot.
It's a lot. Now, some of these things are, way down. I'm talking like some of your meme cryptos.
Yeah, I'm sorry, right? We talked about
your SHIB is down 90.
I'm sorry that your coin that was once worth 8/10,000th of a penny was now worth 1/10,000th of a penny.
Yeah, we talked about this. Like
no signs whatsoever. There were no signs.
There were no signs, right?
There were never any signs that we had gotten ahead of ourselves.
Right, exactly. And so it's an interesting environment from the standpoint of, I don't think we know the full extent of the counterparty risk here at this point. I still think that has to play out. And what I mean by that is during the mortgage creation crisis, and other people call it the great financial crisis, the housing crisis, and really what it came down to is how we were creating financial products built off of mortgages. And when those got rehypothecated, which means multiplied and distributed, the counterparty risk that took place with that, there's probably still plenty of thread to be pulled here on the sweater until that's unraveled in the crypto space. You know, whether it's Luna, Terra relationships, any of the staking stuff, we're seeing exchanges that are blocking redemptions. And I don't say all these
People
things to
asking, wondering why this wasn't FDIC insured. I mean,
right.
it's
And we've spent enough time on this that
Yeah.
I'm afraid that we're causing a little bit of fear. And so I don't want to do that. Just understand what you're involved in. If you're involved in crypto, it's high risk. It's high risk.
Bitcoin from a long-term perspective should have been sold on the break below 30,000. Like it is what it is. We sit at 20,000 now. And you could have bought it back above 30,000. Like, it's okay to have lines in the sand.
Exactly. And so Ian, kind of using that and segueing into something we've talked about multiple times on the podcast is just this concept of correlations moving to one, right? We talked about healthcare breaking down, semiconductors, materials, so stocks and bonds breaking to the downside. The only thing left in commodities are things like natural gas and crude, which got taken this
Crude and energy, which they've come for.
Yeah. So talk to me about, there was one lighthouse out there, and it was energy, right?
Yeah, it was energy. And now that is going to be a failed breakout above 80. You can go back longer term on that chart. 80 is a huge level historically, absolutely huge level. Really, that 79 to 80 range, 81 if you want to call it that. If you pull up a weekly chart, you know what I'm talking about. And yeah, we're back below that. So I mean, is this when we see, like we said earlier, people just went out? I don't care if it's been a relative outperformer. I don't even care that it's in an uptrend. I don't want to own anything. Is that what we're going to see?
Yeah, right. Just everything moves to one. And I would say the evidence is there that you could see an environment where the baby gets thrown out with the bathwater, and people just start unloading things because of how uncomfortable they are across the spectrum, whether they're institutional or retail. And so we'll see what the coming days and weeks bring. Again, always open to the fact that price moves higher here. Mathematically, we're always tracking levels. So you can't go from 1 to 5 without going through 2, 3, 4 first. And so that's what we want to see in markets take place, is enough demand to outpace supply to recover those levels. So with that, Ian, we've covered a fair amount of ground. We're bumping up to the edge of our client portion of the podcast. Going to jump into the extended portion, talk another piece of evidence for that potential risk of downside is something we're seeing with VIX, as well as review some weekly charts, talk about some volume weighted average price. Before we go there, anything you want to wrap up with before we head into that part of the podcast?
No, just that my wife still doesn't have a commodities fund in her 401k lineup.
Yeah, how many?
Still, she hasn't. So
no. Yeah, right. 401k.
Not that I'm just now looking for that, but I think about that from week to week.
Well, and I think there's a big event coming up within registered investment advisors, is when someone rolls over from a 401k into an IRA, is proving the validity of that process. And one of the big things for us is just identifying you're going from a closed garden of a 401k fund lineup into a universe of potentially 35,000.
To a wide open. I mean, you're in a field of buy.
Yes.
Anything long, short.
Right.
Yeah.
You're no longer caged in a beautiful garden of 20 funds. You're now in an environment of 35,000 different things. And it's beautiful.
We'll navigate that for you.
Yep, exactly. And so to your point, 401k lineups right now, not a lot of commodity funds, and
haven't been for years.
For years.
Right. And that's not there. I mean, my wife has Fidelity. It's not Fidelity's fault. It's her employer's fault. I mean,
yeah, I know. I completely understand. And so with that, I know that both from Ian and I, shout out to the dads out there for Father's Day weekend.
Yeah.
I know both of us had impactful fathers in our lives, and we're hoping to do the same for our children. And so to all the pops out there, happy Father's Day.
Happy Father's Day, Dad. Have a great weekend, everyone.
All right, Ian, jumping into the final part of this podcast, a little bit more in the weeds. I know one area that we like to look at is implied volatility using the CBOE VIX product. What are we seeing there?
We're seeing nothing. That's the problem. Yeah, I mean, it just sits here between 30 and 35. I mean, I know, like, obviously last week or the week before we got down in the mid 20s, but yeah, for all intents and purposes.
I just think it's
And it
awesome
doesn't
that-
have to move, right? I mean, I know there's going to be a lot of people like, oh, these guys, no, I understand the VIX. I understand how the VIX works. I would just like, Dave and I would just like to see it move above 35.
Well, it's because we have certain positions,
Yeah.
certain things going on, but that horizontal level between 35 and let's call it 38 on the VIX, kind of an important horizontal level that could play out all the way into the fall. By the way, we could stay below that all the way into the fall and then capitulate higher out of there. But we've talked about capitulation on here how many times?
Yeah.
And a piece of capitulation evidence towards that would see VIX above these levels.
Yes.
And that would be information on throwing the baby out with the bathwater. We haven't seen that yet. To Ian's point, when he said we haven't seen it go anywhere, we've got a doji this week.
I mean, you saw spikes in 2020, 2018, beginning of twice in 2018, right? Now, I say spikes. We spiked to, December 24th, 2018. We hit a high of 35 on the VIX, which is what we're sitting here whining about not being able to get over now. So, right, maybe there's some context there, but 2015, you saw the spike. 2011, 2010, all these sell-offs, all these flushes came with a VIX spike.
Mm-hmm. And so we'll see if we get that, and maybe we won't. Like I said, there's plenty of evidence that we could be moving between there and 22 on the VIX, heading all the way into the rest of this year. And so when we talk about stages, and if we're in stage 4 where it's full distribution, there are periods of stage 4 that are also horizontal chop. And you could see equities move in a bear market bounce. You could see it chop sideways, and you could see the VIX stay below 35 for an extended period of time. Most likely, you're going to see a VIX spike with a capitulation type event. We'll see. Now, maybe we never see it, and
it's just some weird melt.
Yeah,
lower. That's totally valid.
And the big boys, right? We've seen on a relative basis, Amazon breakdown versus S&P. We've seen Google breakdown. The last two generals, Microsoft and Apple, still trying to hold it together here, Ian.
I mean, yeah. Ugh.
I'm not saying
They're
on an absolute basis.
I mean, from a relative basis, certainly
Right.
now, from an absolute basis, Microsoft not too bad. Apple's feels pretty broken. Microsoft continues to hang in there, but yeah, from a relative basis, they have chosen not to die.
Yeah, no, and two big guys like that, Microsoft and Apple, if they're going to be okay and move higher on a relative basis versus S&P, it's going to be, and Ian's talked about this how many times, it's going to be really hard for the index overall, because I mean, those are 10 to 11% of the overall index.
And even
the
more
index
in the
to
NASDAQ, right?
Yeah, to move lower. That's going to be hard. So we'll see. Time will tell. We'll see. We talked about, Microsoft.
21% of the NASDAQ.
Yeah. We talked about Microsoft in the 275 level, got rejected there. However, it is holding its VWAP, its volume weighted average price from the COVID lows on a daily basis. Microsoft is. Apple below the important 150 level, still above its VWAP, and you could argue inside this range that took place from December of 2020 into June of 21. So still work to be done there. If bears are going to take this market lower, you kind of have to take Apple and Microsoft with it. And both of them
have to eventually.
Yeah, and both of them broke important levels. Now it's
maybe. I mean, I guess in theory you don't have to, but
every bear market we've seen, protracted bear market, large correction, months to years, has taken the prior leaders, the big boys, and they've been weak on a relative basis. TBD on those two for sure. For the sake of making sure we get on to our market call, what are we seeing out of weekly charts, the weekly data?
brutal again. I mean, I have gone through, I was telling you earlier today, I mean, 250, 300 ETFs today. Other than those areas I mentioned earlier, I mean, we're all going to close below their May lows. And this is not a good week. It was follow through from last week.
But look, I mean, just even looking at it, S&P cash using something like SPX, on a weekly basis, you literally have a gap.
Yeah, a lot of bad gaps this week.
3,900 and 3840.
A lot of gaps from Monday morning that never got fixed.
And
those
maybe
get filled.
Maybe they get filled.
Are they breakaway gaps? Because a lot of them are through resistance or through support.
Yeah, exactly. I love the fact that you use the term breakaway, and what you mean is breakaway to the downside.
Yes.
And what's fascinating about that is we just got done talking about the VIX up against 35, and you've got these gaps sitting here that could be, the point being, the crash potential here is it's non-zero.
Yeah. And a lot of people are going to say, well, gosh, haven't we ever been through a crash? I would say no. No, I would say there's been no capitulation. I mean, we're getting close.
Yeah, it's interesting because we've got 2% of stocks.
A lot of people try to say the May low is capitulation. No, not. And I mean, maybe how I view capitulation is a little bit more anecdotal than data.
Well, I think it's influenced by price behavior and what you're seeing underneath the surface. Now, we do have only 2% of stocks in the S&P that are above their 50-day moving average, which is kind of a washout area for breadth. However, we haven't seen, to Ian's point, where it's just this massive flush in 1 or 2 days of just everything selling, correlations to one. Now, we have had several 90+% downside days. So there's argument to be made there.
And maybe they never crush energy. I mean, maybe energy becomes
define crush.
And I mean, it's maybe we're back above 80 and
define crush, because energy is down 16% this week. So in 1 week, minus 16%, something like XLE, I could define that as crush. Now, technically, it's still within an uptrend, but I think you brought up before, below $78. It's kind of a false breakout of
and
sorts.
How about oil services?
Okay. Are you using XES?
I'm using OIH, I believe.
Yep. OIH. Yeah.
So answer this, Dave. So OIH from intraday high to intraday low is down 26%.
Mm-hmm.
On oil services in a bear market.
That goes back to, can individual stocks be in a bear market?
Yeah.
I know a broad market can be.
Now, I mean, isn't that great an example of like how silly that all sounds when you try to put like big numbers on, like make up like blanket statements with them?
Yes.
Now, I will say OIH is losing a big, I mean, below 245 it's not a great look. This could definitely get worse.
I would argue an OIH 174, 175 looks like a magnet. I mean, with this false breakout. I mean,
there's nothing. That's the rough part about strong uptrends that don't show a lot of resistance, is when they do roll over, there's not a lot of support on the road down.
Yep. And a lot of times it's the price level seems obvious. It's just a matter of how it's going to get there. So TBD, but it's interesting that they've now come for the final last leader, which was energy
and crude.
The final two big boys broadly are Microsoft and Apple. They did already break their important levels, but will they break them further on a relative basis? That will likely determine the length of this and the veracity over time of this correction. But no doubt about it, there's been not a lot of areas of safety. It's not like you could sit there and say this has been
especially this week. This week was I mean, you look at some weekly heat maps and it's probably going to be pretty red.
Yep. And the only exception to that would be the dollar. A trade weighted dollar, DXY, going to make
dollar big bounce again today.
New weekly closing high, going back to, we're talking about a 20-year high. We've been at this level only once, and that was or not only once, but the last time we were at this level was December of 2002. We'll see if that continues. And if we were to use some textbooks, you would say higher dollar, and that means continued weakness, but who knows? I have no idea. And that's why we use price. That's why we use charts. That's why we have risk management. We view cash as a position too. And we'll continue to use cash as a position as long as these risk off environments continue.
Cash and shorts, yeah.
Yeah, exactly. So Ian, bumped up against the end of our time. Anything else you want to touch base on before we roll out?
Over 50, I think it's 58% of stocks in the S&P below their anchored VWAPs from March 2020.
Walk us through that. So March 20.
Think about that. The average person has been buying since March 2020.
Yep.
Now, I think it's a very broad way to say the average person that's been buying stocks since 2020 probably
March of 2020.
Now showing red in their account.
Interesting.
So right there's some human behavior that goes, just think about that over the weekend. There's a lot of human behavior when you log into your brokerage account, and things that had been up 40, 50, 60%. Now you're seeing red on your screen.
Yeah, for sure. And there's data
and we're
that
just now seeing that. And that's the type of stuff that causes a lot of capitulation behavior. So
yes.
Again, I'm not super
convinced that it's happened yet.
Yeah, that everyone's thrown in the towel.
Yeah,
I like to be the first to throw in the towel.
Yeah,
but
we did. But
yeah.
VandeTrack is the data that showed us that the average retail portfolio down minus 34% also kind of points to that fact that retail hasn't thrown in the towel yet. And so that'll be interesting to watch over the coming days and weeks. And maybe it never happens and we move higher and we reclaim levels. And really that's what it's all about.
Maybe this is 1998 and we have another 200% to the upside before we get a real.
And we'll happily participate in that. Absolutely. But until then, it's risk off behavior below certain levels. We don't need to be involved. There's no sense in trying to catch falling knives. And so we'll let the knife hit the floor and then we'll pick it up when the time is right. All right, Ian, appreciate you. Thanks for being a great dad. Appreciate all the great dads out there. We hope you guys enjoy the 3-day weekend, right? Monday's off, markets closed, and we hope you guys enjoy it.
Have a great weekend, everyone.